So, all right, with no further ado, we should have plenty of agents on here now. Make sure your cameras are turned on, and let's give it up to Mr. Sean O'Connor of Baltimore Life, man. Tell us all about what we got going on here, Sean.
Thanks, Darren. I'm going to share my screen if that's okay.
Yeah, you got it.
All right. So, good morning, everyone. Yeah, Sean O'Connor, Baltimore Life. I oversee sales for the company. So, as you might imagine, we're based out of Baltimore, Maryland. We've been in business now for 143 years. So, we're a well-established insurance company that's not going anywhere. If you're looking for a partner that you can rely on to be around for 140 years to come. Not just to be able to support you all as agents, but equally as important, we need to be financially stable to be able to pay our claims. That's who we are. As you all might know, there's companies that'll come and go. There's startups that they'll develop a new product and be around for a while, and then they'll fade away. We're committed to doing business the right way to be around for decades to come. So we're also a small company. We're compared to some of the big insurance companies out there, we're very small. We have, and I say small, we have 100. Let's see, we've got a surplus of close to 100 million. That's the rainy day fund. And I explain this to clients. If you were to pay out all of your liabilities that you owe, you still have money left over. That's your surplus, right? So that's the what if money. And we're well capitalized in terms of that. We also have roughly $1.5 billion of investments, mostly in corporate bonds, safe places. So another talking point, if you're trying to get a client to understand the safety of working with an insurance company versus another financial institution, I like to share the idea that you feel safe with your money at the bank, but when you go into the bank and you give them $1, they lend out 10. If you give $1 to an insurance company, they keep the dollar and they invest it. So while it sounds safe, right, to have your money at the bank, they're lending. They're in the business of lending to make a profit off that dollar that you give them. Insurance companies invest it to make a profit to be around to pay claims, and so you're certainly a talking point for people that might be skeptical about working with insurance companies. I feel so.
Right.
With that said, Darren, can you all see my screen? You should see our logo and the Heartland logo.
Yeah, we see it.
Okay.
Baltimore Life, Heartland
Yep.
Financial.
Yeah. So we developed a product about 5 years ago with Heartland, and it's a final expense product. That's where I'm going to start, bring you up to speed on it, answer any questions you might have, and then I'll also pivot, assuming time allows, and I have to hop off around 10:40 my time, which would be 9:40 your time for another obligation. But if there's some time, I'll also bring you up to speed on another product that you'll have access to as well, it works very similar to the final expense product, but it's for some larger face amounts, so we'll cover that as well. But we built this. It's exclusive to all of you. The final expense products. You're not, it's not out there. Not any agent can go out there and get the I Provide final expense product, which I think is important.
Yep.
And we built it, like Darren said earlier, we want to be able to give you a product that can cover, different health situations. But we're looking to be your partner for all final expense. If you were to just give us the people with COPD, we're not going to be around very long, right? Because the claims are going to be higher for people with greater health situations. So, we're looking for partners that want to do business with us and really give us all their final expense business. We realize, we're not going to take on some risk, and if we won't take it, you're best off to pivot to a guaranteed issue company. So, I think what you'll find is if we're not willing to make an offer to a client, they're not going to be insurable with another final expense company, but you can always go the guaranteed issue route where there's little or no underwriting. And we tried to make things easy for all of you by giving you the underwriting at the beginning of the process. So our e-application process will start with some basic information to get from the client, things like their name, address, last word, their social. They will electronically sign the HIPAA form, which allows us to look at their medical prescription database, the MIB to see if other companies have declined them, and to be able to give you an underwriting decision up front so that you're not, filling out the whole application, not sure if they're going to get approved or not. So that's not typical in the business, right? Most companies will have you fill out the e-app and then tell you at the end if they're approved or declined. We're going to do that up front for all of you. And like I said, and we do it based on a color code, green, yellow, red. If you get a red, that's a decline. That means we're not going to offer coverage. That's your clue to pivot to a guaranteed issue company. If you get a green, you pretty much know they're good to go. So continue with the app. And yellow is rare. Yellow just means we don't have enough data yet to make a decision. So I would encourage you to continue with the app on the yellows as well. But again, we're here to make things easy for you as best we can. So I'm going to walk through the 𝗕𝗶𝗳𝗲 product, which is the final expense product. This is going to be mostly sold in obviously the senior market. It's final expenses and mostly smaller face amounts. So you'll see we go up to $50,000 of coverage, which might seem like a lot, but if you've been exposed to any sort of paying for funeral and final expenses lately, it's getting expensive. Not to mention, seniors are living with more debt than they used to in years past, right? They're even purchasing homes and taking out mortgages and refinancing mortgages, and they've got credit card debt and other things. So final expenses can be a lot more than just a 10 or 15 or $20,000 policy, which is why we go up to 50,000 for what I would call the younger ages in the senior market, which we'll hit on. So and feel free to interrupt me. I'm not looking at a chat or anything. If you have questions as we go, you want me to cover something, just I'll defer to Darren on that. If there's some time at the end, we can do a Q&A. I'm happy to do some follow-up training for all of you if it would be helpful. I'm going to keep this pretty high level, but we also have some resources here that can help you as you start to work on cases as well. So, what makes us different? Like I said, the e-application with the embedded pre-application process, that makes us different. You can do an app on paper if you have to. It's not real efficient, right? But we have that option for a situation where you can't get an internet connection, which I realize that still exists in certain remote parts of the country. But in general, if you have an internet connection, you can get on our agent portal. You have access to the e-app, and whether that internet connection is via the client's home or your own personal mobile internet Wi-Fi hotspot, or if you're doing business at the office, however you get your internet connection, you'll be able to do an e-application with us. And the pre-app, that's right up front, so you're going to get that decision. Typically in the first 3 to 5 minutes, you can see there, you start an application with someone, 5 minutes later, if they're going to be insurable or not. That's huge. Hopefully you see value to that. And that's really why, we would hope that as you become familiar with us and more comfortable with us, if you make us your go-to final expense carrier, up front if somebody's going to qualify or not. You can always pivot, like I said. It is simplified underwriting, which just means you're never going to have an exam needed, an APS requested will never happen. There's no blood, there's no urine. So we're giving you a decision on the spot. Like I said, they're going to either be insurable or they're not, but there's nothing left to chance. It's 100% automated, which means, we're never going to refer it to underwriting because we're not sure. We're going to make that decision with an underwriter never touching the policy. It's all fully automated using our data and our algorithms to be able to make that decision in that first 3 to 5 minutes. The health questions are very short and easy. There's only a handful of them. They're all up front in the process, and they're reflexive also, which means, Darren brought up a good example. Somebody has COPD. That doesn't mean they're declined. What it means is we need to get more information on that COPD. So in general, if they have COPD, they answer yes to that question. The reflexive questions are going to hit on, are you on oxygen, or have you been hospitalized within the last couple of years due to the COPD? So basically, we're finding out, is it controlled, right? Is it an issue? If they haven't been, if it is controlled and there's no other comorbidities, then they're likely to get approved, which is huge, right? So some carriers may just say COPD is a knockout, we're not interested. We're saying COPD is not a knockout, we just need to learn more about it. Now, if they're COPD and there's other comorbidities, they might be diabetic, they might have high blood pressure, things like that, then that likely is to lead to a decline because of the comorbidities. But the COPD alone, if it's controlled, would not. That's what the reflexive nature of the questions allows us to do, to get more information and compare that to the prescriptions that they're using. As all of you know, prescriptions can be used for different things too, right? You might have the same prescription that can be used for something serious that can also be used for a preventative or a maintenance type drug, and it's less serious. So that's where the reflexive questions can help us. We have a couple of different levels for this product. And by the way, you can sell this product to people starting at age 45. It goes all the way to age 89. So even people that have outlived life expectancy, which is right around 80 years old, they can still get final expense coverage even though they're older than life expectancy. So there could be an opportunity there for you.
Guys, I'm going to chime in. Scott, Sean, I'm going to chime in a few of these and then kind of bounce off a few things you're talking about. But guys, the stuff that he's talking about right here, if you've written final expense anytime at all, you would really appreciate everything that he's just said. The fact that it's rarely, if ever, sent to underwriting, like it goes through the automated process. That's huge, guys, because we've all been to that nightmarish where you wait 2 or 3 weeks and an underwriter come back and then it's a decline anyway. That decision, the reflective questions, the fact that they allow that, too many times we write through carriers and they don't give you the opportunity. So it's like you check the box. If you COPD, boom, decline. This one they give you options. That's just one of the examples that they'll give you. But so they do. We love the reflective questions. The preferred and standard options all the way to age 89. Guys, very, very few insurance carriers go past 85. There's only a few that will go all the way up to 89. And that's even with a standard issue, meaning that they will allow some health issues all the way up to the age 89. So those are some big stuff if you hadn't figured it out yet.
Thank you for that, Darren. And again, yes, similar example to what I said earlier. If you gave us just people that are 86 years old, 89 years old, and nothing else, we're not going to be around too long, right? So we need to spread out the risk. We're looking for that partnership where we're doing business across all age ranges and health situations as well. So for us, the preferred level is, it sounds good. It's really anybody who's, got a clean bill of health through table 4 underwriting. So somebody that might have, I'll use an example, they might have high blood pressure, but they control it with medication. They would still fit into that preferred level, right? You might have somebody that's type 2 diabetic, that's it's controlled. Their 𝗟𝗄 is good. They take the pill religiously. They weren't diagnosed with diabetes until later in life. No other comorbidities, they might be preferred. Most of what you're going to sell is going to fit into that preferred bucket. Roughly 2/3 of our business coming in, it fits into that preferred bucket. And then standard for us is people that are typically tables 5 through table 8. So you have a little bit more of a health situation going on. That COPD example might be a good one where, they fit into the standard underwriting class. So their premium is a little higher than preferred, but they can still get, the same amount of life insurance for a little bit higher of a premium based on their health situation. So, and then return of premium, the modified class is for people beyond tables 1 through 8. So you got more health stuff going on. It's just going to pay a return of premium the first couple of years. And then, beyond that, it would pay the full death benefit. And we're going to limit the exposure there. We're going to do much smaller face amounts, people that have more health stuff going on. We're also not going to write that product or that level, I should say, past age 80, because there's just more risk going on with that client. But you can still write it ages 45 to 80 with some more health stuff going on. Maximum face, like I said, is $5,000 or $50,000 of death benefit. I will show you a product next that will be for your face amounts over 50,000. So we're going to give you the same process in terms of underwriting and EAP for final expense, which is a couple thousand up through 50,000. And then we're going to also give you a product you can sell 50,000 all the way up to 150,000 without any exams or APSs as well. So, the market you're working, don't just assume somebody can only afford a $30,000 or $40,000 policy when you could show them what a $50,000 policy would be, or 60,000. Premium might not be much more. In fact, I've compared clients at a $50,000 policy versus a 30,000, and depending on the product itself, premium might be almost identical. So why not give
Right.
them more coverage? So I'll cover that as well. We
Guys,
do
that's a
Social
big
Security
deal.
billing,
Um,
just meaning that we match up the premium draft to the exact day that the Social Security deposits. So as you can imagine, a lot of Americans, they spend their money as soon as they get it. We want to make sure they pay their life insurance premium before they go to play the slot machine, or pay for other things, right? So whether they get their Social Security on the first or the third of the month, or the second Wednesday, for example, we can line that up, or you can line up their premium to draft on the first through the 28th of the month also. So different billing options, and then also different payment period options. So you can do a life pay, that's going to be the lowest premium. You can also offer a 20 pay, which means after 20 years it's totally paid up, no more premiums. So higher commission or higher premium for the client, higher commission for the agent when you do that 20 pay option, because the commission percentage is the same no matter what. So the more premium they're paying, obviously the more you make as an agent. And then there's a single pay option as well. If they have the money sitting around somewhere and they just want to do a one and done, they could do that. The last bullet point you see on the slide is a important one for the client when they pass away. Even before we get the death claim paperwork processed, we'll give the beneficiary $1,000 up front just by calling us, letting us know the person passed away and that they're going to be submitting claim paperwork. That just gives them a little liquidity to go out and start talking to the funeral home or whoever else might want to deposit. So it's a talking point. It's something that gives you a little bit of a sizzle around the product, and can be something that might give a client a reason to do business with us, versus somebody else that wouldn't pay a claim for a longer period of time. So for example, the client has, let's say they have a $20,000 final expense policy with us. They pass away. The beneficiary lets us know they passed away. We give them $1,000 right on the spot. We can wire it right to their bank account so they have it. And then as that death claim is processed, we'll pay the remaining $19,000 through the normal claims process. Which, by the way, we pay our claims typically in a couple business days. That's another thing that sets us apart from the competition. We turn them around quickly, and we don't require original death certificates up until a certain threshold. And don't quote me on it, but I know in the final expense market, most of our claims come through. Copy of the death certificate's fine. We don't need an original until you hit a higher face amount. So,
Hey, Sean, I'm gonna interject on these four. Go back to that one real quick. I just want to.
yeah,
There's a few things I wanted to just drive home. Just start with the 50,000 max, guys. You guys know most of final expense about 35,000. A lot of times we've had to double stack, right? You stack two different carriers because you can't get that much policy. 50,000, that's a big one. No, Social Security billing is. I didn't realize how important it was until recently when James and I were talking. But like the fact that they got true Social Security billing, meaning that money, the very first money that will come out when that money is deposited is going to be their life insurance. Because we all know that if you just do like, okay, when do you get paid? Your Social Security hits on the third. You set it up. A lot of times they're going to pull that money out of their account. This is what they do. They go out there and go to casinos or whatever, but they blow that money prior to that being pulled out. True Social Security billing means that money is going to be pulled out before anything else is, and so that's going to save you a ton of headaches down the road. The other one I really like, Sean, that you guys, there's things that you guys are offering that nobody else does, but like the life pay is everybody does that. The 20 pay, That's kind of a big deal. There's a lot of clients out there that says, "Do y'all have to pay forever?" Oh no, not really. We got a 20 pay that you can go 20 years and you'll never have to pay again. And you give them that option. But the single pay, I did one of these about 2 weeks ago with somebody. I didn't sell it, but I was kind of quoting somebody with it. I think another agent. And I think we did a 25,000 that they only had to pay $14,000 to have a $25,000 policy. So you actually, so one of this comes into play is if you get a client on the phone and they said, "No, I don't need insurance. I've got $25,000 sitting in the bank ready for me." Well, hey, let me sell you one for $14,000. That's the same thing, and you save 9 grand. And then I love the $1,000 cash. You guys know the value of that. That's powerful. All right, I'll let you get on. I just wanted to kind of hit
Yeah.
on those things.
Yeah, thanks, Darren. You could do this training for me. You're
Yeah,
up to
no, it's
speed
just
on
good
this stuff.
stuff.
Yeah.
All right.
So yeah, to Darren's point, I mean, so many agents just will quote the life pay, and let's say it's $100 a month, and all you got to do is quote the 20 pay. It might be $120 a month, but it's
Yep.
paid up in 20 years. It also builds cash value quicker too. The more premium you pay, the more the cash value is going to build up, right? Which is an asset for the client as well if they need to access it for whatever reason. And I love the single pay also. I mean, the younger the client, the better in terms of how much premium, how much death benefit they'll get for their premium. So you might have a 65-year-old that can double their benefit overnight, just by doing a single pay. They give you 10,000, it's worth 20,000, for example. So just quoting them, I mean, the worst that can happen is the client says, "No, I can only afford the life pay." But we have those different options for you. So this next slide will just show you again kind of minimum issue age and maximum issue age, as well as the different underwriting classes that you can see: preferred, standard, and modified. Our product, like every final expense company, it's gender based, right? So male, female, and tobacco based, non-tobacco or tobacco. It's going to change what their premium is based on those different criteria. But I always say the easiest thing to do is quote it in our agent portal. And if you can't quote it, that means you can't sell it. So, when we're thinking about what's the most I can do, the least I can do, how old can I go, how young can I go? If you can quote it, you can sell it. If you can't quote it, you can't sell it with us. So you can see here on this slide, the minimum face amount's 2,500. The opportunity there might be, you might have final expense customers already that you wrote 5, 10 years ago, and it's not enough anymore. You might have wrote them a $10,000 policy 10 years ago. Cost of a funeral and final expenses now it could be 20,000. So you could add on to what they have. That's why we let you go as little as $2,500 of face. And then the maximum issue age, or I'm sorry, issue amount would vary based on their age. You can see you can go up to 35,000 for the younger age. Then once you hit age 51 to age 70, which is where most of our sales come in, you go up to 50,000 of death benefit. Starting age 71 and to age 80, you can go to 35,000. And then for those people that are already living beyond life expectancy, you can still do up to 15,000 of coverage for that market as well. And it'll reduce a little bit once you get to that next underwriting class, which is standard. So we're limiting the risk, right? The more the health concern, the more that a client has going on with their health, the more we want to limit how much coverage we sell them. Again, it's just controlling the amount of risk that's being underwritten for. So there's only 2 riders. Keep it real simple for you. Accidental death. That just basically means we'll pay double the death benefit if they die in an accident. It costs a minimal amount to add that rider. So, for a few bucks a month, Mr. or Mrs. Client, you've got a $20,000 policy. If you die in a car accident, we're going to pay 40 instead of 20. So it's a way to get extra coverage. Accelerated death benefit is no cost. There's no extra premium. It just means if you end up terminally ill, for example, we're going to pay the death benefit while you're still alive. So instead of the beneficiary getting the money to pay for your final expenses, you're going to get the money, and you can do with that money as you see fit. You might need it for medical expenses or long-term care needs, for example. So that accelerated rider is super important. And like I said, it doesn't cost anything as well. So there's some slides on how that works. I'm going to not get into all the details of that this morning. We can follow up as you have questions as well. There's some examples here on the screen too, just in terms of how the application works. We already covered that, the COPD example. They're reflexive questions. So, the best way to learn this, everyone, after you get contracted with us, you'll get a welcome letter with your agent number and instructions on how to get into the agent portal. Just go into the agent portal and run some quotes. Run a quote on yourself, maybe if you're in that market. Run a quote on mom, dad, aunt, uncle. Just become familiar with it before you're face to face with a client or selling a policy virtually, remotely, however y'all do business. Just to get up to speed. But it's very user friendly. Won't take you long to learn the system and how it works. Pretty straightforward. So a couple do's and don'ts. I always hit on this with any new group to us because it's super important. We look at the relationship as a partnership. We want to give you the tools to be successful. What we expect in return is just good, honest business, right? So a couple of tips for you. Make sure you always complete the replacement information. And replacements aren't a bad thing, right? Oftentimes clients replace policies because it's no longer the right policy for them, or they're paying too much premium for it, or their needs have changed. But just remember, any change in existing coverage is considered a replacement. So disclose that. It adds an extra form to the process, but it protects you as an agent. There's nothing more important as an agent than your license. So you always want to do business the right way and code things as a replacement as needed. Make sure you get all the parties to properly sign the application. Usually the owner is the insured, is the payer. Most of our sales, someone takes out a policy on themselves, they're going to pay the premium, they own it, which means they have all the rights to make decisions, name a beneficiary, for example. But if there's more than one party, if you have someone else that's going to be the owner or someone else that's going to pay the premium, make sure they properly sign the application as well. Don't have just the insured sign for them. That would not be kosher. Couple of don't tips. Don't ever sign on behalf of a client. That seems like a no-brainer, but sometimes agents don't realize that what they're doing is either illegal or unethical. So if a client says, nah, just go ahead and sign that for me, don't do it, right? We offer a DocuSign process via text or email. That's easy because they get a text via their cell phone number or an email that they can click on and sign the app, for example. But you can also sign an application on your device. If you're face-to-face with a client and you're taking the e-app, they can literally on your iPad or your laptop sign off on the application. So the tip is don't ever do that for them. That could get you into some trouble, right? And then also don't ever create an email address for the sole purpose of buying life insurance. The regulators don't like that. They need to already have an email address for other reasons. Now you can always help a client with technology, right? That's not a bad thing, but don't create a email for them just to sign a DocuSign. And then we don't allow offshore lead vendors, which means any lead vendor that you're using has got to be onshore within the domestic United States. They've got to be TCPA compliant. That protects you all. It also protects the company. So if you ever run into a client, trust me, they're out there where they're just looking for somebody to call them that's not supposed to call them, meaning they're on the do not call, for example. Life insurance agent calls them. There's plenty of litigation out there, plenty of lawyers looking to get agents in trouble and life insurance companies in trouble that they're using they're not doing business properly. So we're here to protect you. We're here to work with you. We'll let you know if we see things that are concerning, and we would ask the same thing of all of you too, because we want to make sure we protect each other, which ultimately that protects the consumer, right? Just making sure we're doing business the right way. So that's where I'm going to wrap up with this product. Any questions, Darren? Anything else you wanted me to cover on that product before I pivot?
No, very good. It's good. Good products. So.
Okay, let me try to move out of this document. And then I'm just gonna
I provide with the one we just covered.
Yep, I provide. So I provides the final expense product, like I said. That's going to be on everybody that you're writing in that senior market. And then let me see if I can move this to a slideshow. Here we go. So now I'm pivoting to a priority whole life. So you all have access to this as well. This is going to be for your higher face amount, so over 50,000 in the senior market. But you can actually write this in the younger market too. So if you're If you're doing business with people that are under age 45, you can write a priority whole life, and you can do real small face amounts for the younger people. A good example would be when my daughters were born, I did a $50,000 a priority whole life policy on them. It's paid up in 20 years, and it's a policy that once it's paid up, I'll continue to be the owner of it. If I want to give it to them, when they're adults, I can, or I can, keep it and leverage it as one of my assets. But so this product that we're going to cover now, you can write it on all ages. So newborn babies,
Beautiful.
all the way up to age. Now we do cap this one at age 80. So where the first product goes up to age 89, this one will go to age 80, but you're going to see it's for higher face amounts. So it's participating whole life, which means it pays dividends. So if you sell a policy, you sell a client, let's say a $50,000 policy, because there's dividends, over time that $50,000 will grow. Those dividends will buy additions to the death benefit, so it can be a good hedge against inflation. So over time, that 50,000, maybe in 20 years, it grew to 60,000, for example. So if you're familiar with dividends and participating whole life, that's how this product works. It is a level death benefit, permanent whole life policy. So there's nothing left to chance. So unlike term or universal life or all the different variations of life insurance that are out there, what's great about whole life is it's guaranteed, and there's nothing that's going to change unless the client changes it, right? Level death benefit. Premiums will never increase or change, right? So unlike term, which, term's inexpensive short term, no pun intended, but after the term period, if you still need coverage, the price goes way up. Same with universal life. It might be, one premium to start, but over time, they might have to pay more to keep it. This product also offers the life pay and the 20 pay option, so you can have it paid up in 20 years again. The cash value is just like the final expense product that we covered. There's cash value that builds up within the policy as well. And there's no non-forfeiture values, which just means, if the client decides to one day to stop, they no longer want to pay the premium, they could do what's called a reduced paid up policy. So there are some options with whole life down the road as well. Dividends aren't guaranteed. We've paid them every year for 143 years, except for 2 years. 1 year during the Great Depression and 1 year during the housing crisis. We didn't pay a dividend. Every other year for 143 years we did. So even though you can't guarantee them, when you run an illustration for the client, you can show them the death benefits level and guaranteed forever. The dividends, you can also illustrate that so they can see how it grows over time. They just need to know it's not guaranteed.
What has it been running? Do you have any idea, Sean, like the participation rate?
I don't, Darren. It's a good question. The illustration is a great way to actually see it. If you're a visual person, you can see over the course of that client's life how those dividends grow. So I'd encourage everybody to play around with that a little bit once you're in the system.
Yep.
Accelerated death benefit, same as the first product. Basically, if you need it while you're still alive, you can use your life insurance to pay for things like long-term care. And then even if the client lives past age 100, which more and more people are doing, we don't make the policy owner cash it in. They can leave it for their beneficiary if they choose. It just means that their policy is paid up, it's matured at that point, and we're seeing that more and more frequently. Like I said, with people living longer. So, like I said, you can sell this product in the all markets: young families, established families, pre-retired, retired. If they need larger face amounts. And this slide that you can see now, this is the best reference tool for what's the opportunity? Where are you going to sell it? So newborn babies, you can go as little as 15,000. The maximum is 150,000. No underwriting. So
Wow.
I should say no physical underwriting, right? No exams, no APSs. Starting at age 50, the minimum face amount goes up to 50,000. The reason for that is we don't want you, competing against yourself in the final expense market. So from ages 50 to 80, if your client needs 50,000 or more, this is the product for you. If they need under 50,000, you're going to sell that first product we covered. which is the final expense product. Maximum is 150,000. Like I said, you can write that on people of all ages, and the underwriting works the same way. So you've got two underwriting classes here. You've got standard, which is really standard through table 4, and then you've got special, which is the higher risk, table 5 through table 8, tobacco or non-tobacco. And then for the older ages, the maximum will reduce from 150,000 down to 75,000. So we're going to cap it once you turn age 61. The most they can do for this product is 75 instead of the 150. Again, it's a higher risk, right, for the company. Remember, if you can't illustrate it, you can't sell it. If you can quote it and illustrate it, that means you can sell it. And so, again, I think a great product for all of you once you hit the larger face amounts. I'll give you an example. If you have someone, let's just say they're 60 years old, if you quote them the final expense policy for 50,000, and you quote them this policy for 75,000, your premiums are going to be almost the same. So why not give them, more coverage, give them a higher face amount if they have the ability to pay for it. Obviously, the lower face amounts, you're going to stick to that final expense product.
Hey, I'm going to chime in,
Yep.
Sean. Guys, I know a lot of you come to me and ask about children, right? And this is a great example of company we can start using. You'll say, well, the parents want to take a whole life policy out on the kids. And typically, if you don't want to write or you don't want to write a children's rider, but they want a true whole life policy, this is where we're going to pivot to. But I think before we did American Amicable a lot of times on family choice, but this will give you a lot more options and you can go up a lot higher in premiums. So just keep this in mind when you're doing a family and they want to take a policy, a whole life policy out on their kids. This is probably going to be our go-to company.
Thank you, Darren.
Yep.
So that's what I wanted to cover. We can get deeper on additional needs and training and support. But are there questions for me before I jump to my next call? Anything else you wanted me to cover, Darren? Or
No, anybody, if you have a question, put it in chat, and at the end we'll answer all those chat questions.
Yep. So like I said, I've got just a minute or two left. See if there's anything else here to cover. Yeah, a lot more riders with this product. So once you get to the higher face amounts, the over 50,000, you're going to see on this slide a bunch of different riders. Some of them have a cost, some do not. Waiver of premium, if they end up being disabled, they don't pay the premium. Accidental death, we covered that before. If they want to add their children as term riders, they can. There's a guaranteed insurability option for kids as well. So, I call it a family plan. Let's get a whole life on mom and dad. Let's add the kid as riders or the kids as riders. If you do the guaranteed insurability rider, that just means they can buy more coverage even if they have health issues. So, you're setting that plan that family up to be properly protected both today as well as potential future needs as well. Disability income rider that can replace some income if they end up needing disability. So that, this product, it's got dividends, it's got a lot more rider options as well. Final expense is pretty cut and dry in terms of what the features and benefits include. This is going to get a little more in depth, so I won't cover all these riders.
Sean, is the cost about the same on these? Is it A provide, is it I provide, or A priority?
Just slightly lower for this product, so the final expense is going to be a little bit higher.
Yeah.
But they're similar. Yeah, that's a good question. So that's it. Like I said, I got to hop. Darren, you've got my contact information.
I do.
Let me know how we can help. If you're new to us, I'd encourage you, like I said, get contracted. Let's get you into the agent portal. And then we have I'm going to see if it's on the last slide here. We've got an agent services department. You can call an 800 number and get help. You can email us and get help. There it is. You see the 800 number right there. So they're there to support you too when you run into problems or when you need something. But Darren will have my contact information. Y'all can call me or text me, and we look forward to working together.
Sean, we appreciate you, brother. You did a good job, and guys, and we'll keep them on every so often. We'll bring them back on board. And Sean, if you ever guys get new products or something, just holler at me, and we'll have you back on here. Okay?
Sounds good. All right. Thanks, everyone. Have a good day.
Thank you. All right. You guys stick around and we'll visit some. And what do you guys think? Good training. I know Baltimore Life has a lot of good. I'm watching that. There's a lot of good stuff there. The fact that the $1,000, I can go through piece by piece and tell you why I would encourage you to look at Baltimore Life. The $1,000, have you ever heard of a carrier doing that? That will actually send you the client $1,000 upon you turning in a death claim. That how nice would that be for that family? Not, because it takes a while. Sometimes it takes a little bit to get those checks in. $1,000 would go a long way. So that's a really neat benefit. So many different things they were offering that I like, but I really like the underwriting with those guys and between them and Americo, I've been declined with other carriers, and I switched either to this company or Americo, and both of those have almost always got me approval. So it's nice to have a company like that in your back pocket. The fact that you can do I provide or a priority. Remember, the a priority is a participating whole life policy. It's going to build up stronger cash value, and it goes up to $100,000. I like the fact that you go 0 to 80. So if you got children, you can sell that policy to younger people, and that's important. A lot of times, our only area we can really go with either a SICA, which nobody wants to write that crap, and or maybe go to the other one was senior, American Amicable Family Choice, which is good. I have nothing wrong with that one. But now you got options to go with. So I think you can get a lot more coverage with this and up to 150 for a child. That's really good. And imagine those rates are going to be very cheap. I like the fact that you do a 20 pay on a child, and then that thing is building up participating whole life. So it's actually building strong cash value. I'd be interested to run some illustrations just to see where that runs. So questions for me, and after this, I want you to stay on because we got another topic I'm gonna go into. Jane and I are about to talk about, but let's stay in our lane right now. Any questions on Baltimore Life for me? Go ahead and unmute. Or Leanne, would you want to help me here? If you want to read the chat for me, and if you have a question, put it in chat, and Leanne will read those, and then I will try to answer
All
or
right, so
comments.
Brian asked a question, do we need the full Social Security number?
Oh, what a great comment and question. No, Baltimore Life only asks for the last four. So what a great deal, right? So if you're doing telesales, how many of you would raise your hand if you've been doing a telesale and you get to I think we all can, probably two hands and both feet. If you've ever got there and they hang up on you when you ask them about the social. So, but they'd be willing to give you the last four, but they don't want to give you the whole. Now, I've kind of have figured out how to get the whole social, and I don't have that issue anymore like I used to, but still, the only last four of your social is all they need. So good, Brian.
All right, next question is from David. What happens when the child policy hits maturity age? What age is that?
Okay, if you're doing so, once again, these are whole life policies, right? And so, if you are 3 years old and you took out a policy, if you did a 20 pay, then
You stop
then
paying
you
at
don't
age
have to pay at 20.
23.
You stop at 23. You don't ever have to pay again. If you did a whole life pay, I would imagine those premiums are so low that you would probably be paying on it for the life of the child, as long as he lives until, I don't know that you ever reach maturity. They're
Yeah.
going to be very inexpensive. That's why I would say probably do a 20 pay on the children's policies. If not, they're probably just paying a few dollars a month and it's building part. Once again, those are participating whole life. So even though you're putting money into it, you're building strong cash value. So it'll become worth more than what you put into that policy. Yeah.
Darren,
Anyone
this is
else?
Teresa. Did he mention if they accept people with ITIN number or just a social security number?
Did he say, did anybody know that question? JP's been writing some, Daniel's been writing some. I don't know if Misha has or not, but do you know about the I-10 number? I don't remember if they do or not. Top of my head. That would have been a good question for him.
For Baltimore Life, I don't believe they take I-10.
Okay. We'll do a double check to make sure of that, and I'll post in group me once I find out. But I think JP is correct on that.
Yeah, I
Thank you.
think we're just good with National Life Group, American Amicable for I-10. And then who else, Darren? I can't think of any.
I think the new one is I think it's Surety, the one we just recently picked up that does that.
Nice.
Yeah, so we got a few that we're working on trying to get more. And then and if I find of any others, I'll post Teresa, because I know you guys we do a lot with the Hispanic market that we need to get that those carriers with. So we'll keep working on them.
Thank you.
Anybody else? Okay. Jane, can you unmute yourself? Okay, now let's talk about the something else now. We're going to transition. That was a good training. How many enjoyed that training today? Yeah? You feel like you learned
Yep.
something? You
Yeah,
feel
that
like
was
you got a
great
carrier
training.
that you feel comfortable with? I like
Very good training.
149 years. Oh, are you kidding me? I
Yeah,
always
that's
like to
awesome.
say they've been around since before the invention of the light bulb. And like you can truly say that with this carrier, right? So somebody said, well, I don't know about, I've never heard of them. Well, they've been around before the invention of the light bulb. And that's true. So, this company has been around for a long time. And so that's longevity in life insurance is an important selling point. So write that down if you hadn't written that down. That's a good selling point.